Welcome, my name is Graeme Prowse and I'm a Director of Webb Martin Consulting. I'm here today to talk to you about one aspect of succession planning that advisors should be considering. When a plan is being formed, advisors and their clients often think about the costs and effort involved in setting up the plan. They don't often think about the costs and other issues that can arise when the plan needs to be unwound. To explain what I mean, I'll run through a simple scenario. When a family sits down together and works out the plan for the succession of the business, then often it is because there is an adult son or daughter who works in that business. The parents are stepping back and taking time to retire. The adult child is looking for certainty in relation to them being able to control and hopefully own the business, and the parents are generally looking for a continued income stream so that they've got something to retire on. Often in such scenarios, the plan that is developed is that the business or the entity that owns the business passes in terms of control and ownership to that adult son or daughter. The freehold property, if there is such, often then is transferred into a superannuation fund, allowing the retired parents to have a rental income stream to live on in their retirement years. There are obviously CDT costs that arise in relation to this sort of a scenario, generally in relation to disposal of the business and the disposal of the freehold property. These costs can be reduced and sometimes eliminated through the general discount, through the small business CDT concessions, and if the business is owned by a trust, often through just the change of control of that trust, as the parents and the children will generally be beneficiaries of that trust. In this scenario, the plan will work quite well for the period of the retirement of the parents. However, issues can arise when the parents die. Upon the death of one of the parents, or both of the parents, then the superannuation fund is in a position where it needs to pay out a death benefit lump sum amount to the estate of the parent or to a nominated beneficiary. In that scenario, the value of the property as compared to the value of the member's account in the superannuation fund can be a critical issue. If the value of the property is more than the value of the member's benefit, and there are limited other assets in the superannuation fund to allow that benefit to be paid out, then the superannuation fund could be in a position where it needs to either pass that property out as a death benefit ETP, or alternatively, it needs to sell that property in order to be able to fund the death benefit payment that it needs to make. The superannuation fund trustees need to be aware that they are required under the SIS Act to make the lump sum death benefit payment as soon as is practicable. When that is translated into what actions they need to take, relatively quickly after the death of the member, they need to take action to determine the value of the property and potentially put it up for sale, run the sale process, make sure that the sale occurs and is settled, and that then they've got the monies to pay out that lump sum benefit. All of this action has to be taken whilst the family is concerned about the loss of a family member and has other pressing issues on their mind. The CGT issues arising from the sale of the property by the superannuation fund will have income tax consequences for it and potentially for any beneficiaries that have lump sum payments made out to them as well. Where the family wants to retain overall ownership of that property, then there are concerns as to how that can be managed when a sale process needs to be undertaken by the superannuation fund. In order to show that the SIS Act, particularly Section 109, is being complied with, the superannuation fund trustees need to ensure that the sale is undertaken on a market value or arm's length process so that they can ensure that any inquiry by the tax office as to whether they have met the requirements of the SIS Act, particularly Section 109, have been met. This may well require them to reduce their own risk by putting the property up for an auction. The risk in an auction is that there is a third-party bidder looking to buy the property, so that there is real commercial risk for the family in following this path. However, to not have a sale that you can prove to the tax office has been made on a true arm's length basis could expose the fund trustees to civil and criminal penalties. So it is an issue that is worthy of attention.